Today we're going to talk about adjusting entries, and we are going to use the Accruals worksheet to go over some of the entries that you might see that are accrual based. So with accruals, remember this is where cash has not changed hands. Alright, so cash has not changed hands at this point, but we have either incurred an expense or we have earned that revenue. So the different types of accruals we have are accrued revenue. This is where we have earned service revenue or we have earned, so remember the key term here, we have earned service revenue or we have earned interest revenue, but it has not been recorded in our books yet. And then for the accrued expenses, we have incurred these expenses, but we have not paid for them yet. We're going to pay at a future time, and this would be those like interest expense and wage expense. Remember, with these we are using that revenue recognition principle and the matching or expense revenue principle are the principles that we use when we look at adjusting entries. So the first one that we have on the worksheet says ABC has income that has not been billed nor received. So we haven't received the cash, it hasn't been billed yet, but we have earned this. So since we've earned it, we need to record this in our books, and the journal entry that we use here is very similar to, or actually it's the same journal entry that we would have done when we actually billed this. This is where we have something that is really on account, and we just haven't billed it yet, but it still is income. It's still revenue because it has been earned. So the journal entry that you would see here is you would be looking at a debit to the accounts receivable of the $5,000, and then you would have the revenue, which in this case is service revenue, for a credit of $5,000 is what you would see. Again, it's been earned, but it hasn't been billed or received yet, so we do have to do this adjusting entry. The next one we see deals with interest revenue, and it says XYZ has interest that has been earned of $125, but they have not received the money yet. So cash has not changed hands yet. They have not received $125, but we have already earned it. When you run into this case, what you will have is you will have a interest receivable account, because this $125 will be coming in at a future date. We just don't have it yet. And the other side of the entry would be that interest revenue for the $125. Now, what I want you to see here, and what we see most of the time when we are looking at the accruals, is you will see like interest receivable, you will see interest revenue. So, these titles here are going to have that same beginning where they both are looking at that interest. It's just one's an interest receivable and one's an interest revenue. And we'll see the same type of thing when we look at these next two when we're looking at these expenses. So here it says ABC pays $10,000 a week in wages for a 5-day work week. The end of the month is going to fall on a Tuesday. So what we need to know is how much do we pay per day? Well, if we pay $10,000 a week and it's a 5-day work week, that means that we are paying $2,000 per day. So, and if it falls on Tuesday, we have Monday and Tuesday that's on 1 month. We have Wednesday, Thursday, Friday that's on the next month. So this gives us 2 days for this month that we need to accrue. So we would take that $2,000, multiply it by 2, and we would have $4,000 that we would need to accrue. So the expense here would be the salary or wage expense, or you could have a salary expense, you could have wage expense. It really just depends on your chart of account. So here we have a salary expense, and it will be for that $4,000. And the other side is going to be a salary payable account. So again, we come in and what we see is that beginning, that salary is going to be the same, and then we list what we have. So we would have an expense, and then we do have to pay it in the future, so that would be a liability, so we would see the salary payable. The last one on the worksheet is ABC has accrued $500 in interest expense. So in this one, we have the amount. It has been accrued. So there is an expense there, and so we do have to put that expense out there. So we would have interest expense, and that interest expense would be for that $500, and the other side is going to be interest payable because this money is due. We do still have to pay it. This would occur on things like if we had a mortgage or if we had a loan, let's say, that was, due in 1 year, and, December 31st falls partway through that loan, we would have to accrue that interest expense for the year that we are currently in, even though it wouldn't be paid until that next year. And that's what we see here. Again, if you'll look at this, you will see the fact that we do have the interest there. We have an expense. We have that payable because it will be paid in the future. The other thing that I want you to remember in looking at all of this is that you will have one account that is that income statement account, and then you'll have one account that's a balance sheet account, and that is for all of your adjusting entries. So one that's income statement, one that is balance sheet. Here you see this one is an income statement account, that one is a balance sheet account, and if we go back to the other ones, here we have a balance sheet account, here we have an income statement account, and for the last one, this was your balance sheet account, this is your income statement account. So every journal entry that you see, just to kind of recap, is going to have one from the income statement, and it will have one from the balance sheet. And just as a reminder, for adjusting journal entries, we never, ever are going to use cash. That is a big no. We do not use cash, but we will have one item that does come from the income statement, one item or one account that's going to come from the balance sheet for every entry that we see. So this pretty much wraps up what we have for those adjusting journal entries. You've already had a video on the prepaids and deferrals, and then this is the ending with those accruals.